Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. I am so honored to have one of my initial guests of the new Debt Doctor podcast is my good friend Anthony Ferrando. He is a Texas man, living in the Dallas area right now, spent a lot of time in Austin, and is here to tell us a little bit about really the boots on the ground experiences that he's seen just in the last year around Texas, especially around the Austin area. Anthony, welcome.
Hey, thank you for having me, Bill. It's great to be here. And yeah, I've lived my whole life in Texas. I've worked my entire career in Texas. I actually grew up in Southeast Houston. Then I went to the University of Texas, and I got a degree in writing. And midway through getting that degree, I had this sudden realization that I would need to earn money after college. Uh, I started to see the light at the end of the tunnel, and there wasn't a vehicle there. Nobody was waiting to help me, and the degree in writing, I started to get worried about, but I had a friend who was in real estate, and I thought, gee, if he can be successful at this, I certainly can. You never think your friends are that bright or talented, because they're your friends. Okay, so I thought if this idiot can do this, I can certainly get into real estate. And so I started as a real estate agent, became a real estate broker, and then I actually became jealous of my lender. I had a loan officer, and I'd be showing a house on a Sunday. He would be watching football, and I would call him. He had wonderful service though, because I'd call him. I needed a pre-approval. Oh, no problem. 3 minutes of work, he's back to watching football. I'm still running around town showing houses. So then I got into the mortgage business, and then a few years ago opened my own mortgage company, and here we are today. So
yeah, and that's really interesting. You play in a very small niche within the mortgage market, and what we're here to talk about today probably isn't going to be going down that niche. But why do you basically are first time home buyers, right, with mortgages?
Well, it's interesting. We only do 3 different loan programs, but they make up the vast majority of all mortgages, actually, right? We only do conforming loans, and so that's conventional FHA and VA loans. And that also includes USDA loans, but we don't do those. But conventional FHA and VA is what we focus on and what we're the best at. And but you're right, and it's not just first-time home buyers, right? A lot of people moving up or down. There are investors as well. The best rates, are on those conforming loans, but often people can't fit in that box, and those would not be folks that would be the best fit for me and my company, right? So, and I know the topic for today is something probably completely different from conforming loans, but there are a lot of implications, to conforming loans, and these type of loans are the most popular, right? Most homeowners
Right.
have these loans.
And and these are government backed or government either insured or and so that's why a lot of people turn to them because the insurance rates are better and the LTVs are higher. But you have to meet a certain box, a certain criteria. And it's certainly one of the things I know I'm seeing in terms of the new originations in the last few years, like the vintage of the last 2 to 3 years. And this does kind of get down into the world of where I wanted to. You told me this story about one of your clients in Austin, and this really kind of gets into that world and what I want to talk about today. It's an example of why the debt doctor is necessary. It's why what Americans are facing right now as markets start to turn in another direction. Well, one of the alarming things I heard from the MBA last month was that the default rates on these new vintage, like last 3 year origination FHA loans, is in the teens. It's in the way into the double digits by now, and maybe into the teens, and that is you have your own little story. We can do a whole conversation about what that means, why that is, what brought that about. That's not what I'm interested in. I'm interested in is a very specific case study that you can tell me about is your boy that you got an FHA loan for
Hmm.
back about in that vintage, right? 2, 3 years ago.
Right. Right. Yeah. In 2022, I met this guy. And by the way, this was just, the peak, or I call it kind of last call for alcohol at the mortgage party was
Right.
April, May 2022. And
Mm.
if you're in the Austin area, which my company's Mortgage Austin, it's based in the Austin area. We had the craziest, most amazing party for a couple of years. 2020,
Mm.
2021, half of 2022. It was this unbelievable time.
Wow.
This is how easy it was to get business. Yeah, I met a guy. He said, "What do you do?" I say, "Oh, I do mortgages." He said, "Great. I'm buying a house. You should help me with the mortgage." I said, "Perfect." And so I end up helping him with his mortgage. We became actually good friends. He had planned to keep that house originally for a very long time, but life happened, things changed. I said, "Hey, look, I'll help you. I'll list it for you, no problem."
It was about 6 months
But
ago, right? I guess this is, or what was this?
yeah, this was last year. So this was
So he
like last
bought this
summer,
house in Austin a few years ago,
August of
97,
2022.
August of 2020, which is basically, isn't that what you say marks is that kind of the well-known fact amongst Austinites that August 2022 was the top of the market and it's been downhill since then, or is
May of
that
22 is statistically the peak.
May
That was the
22?
peak of prices. That was the peak of volume. May of 2022. It has literally been all downhill since then. We're in May of 2025 now. So that was exactly 3 years ago that the party ended.
Right.
Okay. And so he bought this house in August of 2022, still thinking it was like February of 21. Realtors didn't figure out the party was over until like May or August of 23. Okay. They
A year
spent a
later.
year either ignorant or in denial. Mortgage people, I knew January of 22 because we lost 30 basis points per day on average every day in January of 22. I
Wow.
coined the term mortgage hell that month because that was what I was living in, mortgage hell. So by May, I mean, by May, I felt like we'd already reached the bottom. Little did I know, right? And
And
so
for the layman's out there, when you say you lost 30 basis points each week, that means that rates actually were going up 30 basis points each week, about a third of a point each week. Is that right?
correct,
Yeah.
correct. And that third of a point is not, no, and it was 30 basis points each day.
Each day.
Each
Wow.
day. And that 30 basis points is not on the rate, it's on the pricing. And so if you have $100,000 loan, that 30 basis points means the price for that, and you got like a 3% rate, the price for that rate just went up, whatever that is, 30 or $300, Yeah, for 30 basis points, that price just went up $300. And so for that same $100,000 loan, by the end of the week, the same rate is a point and a half higher. It's $1,500 for the same 3% I told you about on Monday while you were searching for a house. And so it's like everyone I talk to every day thinks I'm like scamming them with higher rates, because they just every day they keep going up.
That was early 2022, basically.
Yep, January of 22 and kind of into that spring season.
And it's so great to hear this kind of stuff. I mean, not great to hear the demise of your business,
It was awesome.
my friend.
It was a great time.
But it's good to hear the reality of it because not a lot of people, there's just so much disinformation out there. And I think it's also a little bit of wishful thinking. When you come to the end of a bubble, a long run of up in terms of all asset classes, then the deniability factor sets in.
Oh, yeah.
That's why you see the stock market back up from a few weeks ago. I mean, it's like this, we're still in crazy town. So let's give people some reality then here. So there we are. Okay, 2022, he buys at the top of the market. Now, 6 months ago, he comes to you and says, we need to sell it. Roll us out the numbers.
Okay, so he buys the house in August of 22 and he pays $435 for it. And he does some upgrades to the house, like windows and doors, finances these upgrades. So he's got like another 20 grand in debt or something on that's rough, but roughly 20 grand in debt. Right. So he's really into this for about $455,000 and he gets an FHA loan. So he puts 3.5% down, but half of that goes to UFMIP. So, he's really putting, about 1.5% down. So he's got a mortgage balance 2 years later, because he reaches out summer of 24 and is mentioning, hey, actually, I'm going to sell this house that I thought I was going to keep for a long time. My life plans have changed. I'm moving across the country. So I said, hey, I'll help you. I'll list it for you.
Yeah.
And we list it. And by the way, they think the house is worth like 500 or more. They're actually wondering how much they're going to walk away with and take with them. Okay.
Oh my gosh.
So the first hurdle is, hey, we're going to be very lucky to break even here. We're going to be very lucky. So we list it for $450.
Right.
2 years later,
what he owes for it. So he's going
to what he owes for it.
So even when you're first listing it, he's going to have to come to the table with money based upon that price.
He's still got to bring money to his closing costs, right? Even if he gets that, right?
But you figure, okay, if the market, if you underpriced it like he thought, then
exactly.
It would get bid up, right? But
exactly.
That's what you figured. Okay, good. It was a
good
idea.
And I believe that, by the way. If let's say it really was worth $500,000, if we had priced it for $450, there's no way that I would have let him just take the first offer at $450 because we would have a line of people out the door wanting to see it. When I sold houses first full time, that was my strategy, was to underprice on purpose, pull the offers, bid them up against each other. You only have one house to sell. I mean, supply and demand either is the law or it is not the law. So if you can lower the asking price, it will create that demand. And so I thought, well, hey, at $450, probably it's got to be worth somewhere around there, right? And let's see what the market thinks. Nobody wanted to even come see it. No showings.
Wow. And this was when? This was 6 months ago? This was what? End of last year?
This was like July or August of 2024.
Okay, so
like pretty much exactly 2 years after he bought it.
Yep.
Nobody wanted to come see the house. So I said, hey, let's do something crazy. I know this is crazy, but I talked them through the supply and demand thing. And hey, if we dramatically underprice it, then we will have people come and see it. It will be a feeding frenzy.
Exactly.
Maybe we could even get to $450. Who knows? Probably not. If nobody wants to even see it at this price, probably not. But we have a much better chance of getting there if people are seeing the house than if nobody's coming to see the house.
Right.
So we lower the price to $399. People came and looked at the house, but nobody wanted to buy it.
Oh.
But when we lowered the price, a very interesting thing happened. You know, you always have these lowballer guys that come around. I'm sure every city has like one or two companies of frat boys who write these wholesale offers on every listing.
Right.
You know, let's say the house really was worth like $450 and we listed it for $400. The frat boy companies will write you an offer for $300 or $250 or something with their cash buyer, and they just, you know, bought one down the street with them, and they, you know, whatever.
This is like the world of young investors, basically, and
Wholesaling.
wholesaling, right? They're huge in Florida, by the way. I mean, and I wouldn't, and I'll admit, in my 20s, that's what I did too. I didn't
Yeah.
have the
Hey,
money to buy deals, so I went out and locked them up, and then would try to flip them, flip the contract. So yeah, no, I totally know that whole world. There's been, and not only that, but like I've been out of that world, the individual flipping and dealing with that. But from what I've seen, there's like entire um guy gurus, quote unquote, that have done shows, and there's
oh
TikToks
yeah.
and there's Instagrams, and this is how a lot of the young generations learning the real estate business is through this kind of stuff, right? So yeah, this kind of wholesaling. How do I get creative how do I make more money in real estate with no money? That kind of things, right?
Exactly.
Yeah, yeah.
Exactly. I have no money, but now I'm a real estate investor. And
Exactly.
okay, me
I
and
was one of those.
my group. Okay.
That's right. That's right. They
Yeah.
sometimes it's real estate groups too. Exactly. So they can
Well, I
all
love the
take
real estate team, and you go to
right.
the real estate, it's like one guy. Okay. and like his wife or girlfriend who doesn't even have a license, but they just need an extra,
Exactly.
you know.
Yeah. Welcome to the
I knew
team. Right.
somebody Bill. I knew somebody who sold no houses, but they were their own team. But on their team page, it was like them, their title company person, like their preferred lender, their broker. They had like 4 people on their team, but none of them. I mean, it was all people they were paying basically. But anyway, so
Right. That's so true.
we're getting the low baller wholesaler offers.
At this point, this is like coming up to the end of last year, before the holidays, around the holidays. It was it because I know
I
that.
have a lot more ADD than that with this. This was like 2 weeks after listing it or something. Okay. Bill, I
You
don't
didn't wait
wait. I'm
around.
not the
Okay.
6-month guy. All right.
Right.
I'm not the the listing agreement says 6 months, but I know in about 10 minutes if this thing's going to sell or not. Okay. I mean,
Right.
it's
That's right.
it's
By
pretty
the way,
obvious.
it's very obvious, and that's a very good way to look at it. It's one of the things when I learned how to list real estate, one of the most important things was price. It's no
It's
reason to take a
everything.
listing that doesn't price well, because it's never going to sell anyways.
Yeah. The biggest lie is that the 3 rules of real estate are location, location, location. It's not. It's price, price, price. Price,
Exactly.
price, price. If you're not getting showings and you're not getting offers, it's because your asking price is too high. Now, we could debate about why the asking price is too high, what part of it you overvalued in your fantasy world of value, but the market's telling you, okay, everyone has Zillow and Realtor.com. They know your house is for sale unless the asking price is over their cap.
Right.
Then they don't know it's for sale. Okay, so the only people that know it's for sale would rather go look at something else for the same price all day long, and that's why
That's a
nobody's
very
coming to
good
see it.
point. And that's exactly right. That's what we always used to when we had regular sellers in the brokerage world. We would always say, listen, you want to at least get into that range
Yeah,
where other buyers coming into this market are actually looking.
yeah,
Because their brokers or them are putting in, oh, I only can afford up to 400,000, or something like that. In the case of what you were
exactly.
saying,
And
makes
so
sense.
then we started to get a very interesting type of offer, and I'm using the word offer extremely loosely here.
Yeah.
Anybody who does real estate would refer to an offer as a contract that's been signed by one party, that is filled out completely and is able to be signed by another party, which would then make an executed contract.
Right. With a copy of an escrow check and, all that
Right.
stuff.
Right.
Okay. That's an offer. Yeah.
So I'm using the word offer, but this is not what I was getting.
Okay.
Okay. I was getting weird emails and sometimes calls, usually and I hate this when they drop a voice, they call and it rings once and then it goes straight into my voicemail and I can't answer it because they're dropping voicemails on me. All with this same message.
Mm-hmm. What is it?
They are ready to buy the house and take over the mortgage for my client and give them an additional $5,000 that they can walk away with. And pay me a 3% commission as the listing agent.
Sounds really enticing.
Pretty amazing, when you've got $425,000 in loans plus whatever the repair lien was. I don't know if that was included in the deal. We didn't get that far. But everyone's willing to pay like $40,000 to $50,000 more
than the
for
list
a house.
Price.
Yeah, than the price that nobody else wants to pay straight up.
Right. And they're doing this because of what? They're doing it.
Well, they want to do a subject to transaction. That's you have to kind of read between. You got to kind of do some research on what they're actually saying in the email. You got to really be paying attention,
right,
to figure out what these people are trying to do.
Right. Brokers beware, by the way. You guys get this stuff. I know.
Oh man,
too good to be true. I've got offers on my property.
Here's the crazy thing. They had some other houses they used as examples in some of these emails. I guess some of these more successful subject to people that hit me up. And sure enough, these houses came off the market, withdrawn, and there was a change of title, at the county. Okay, with the lien still staying on there.
Wow.
Okay, and so what these people do is they are buying the property, but the actual mortgage is not being paid off. So the seller of the property is keeping the mortgage in their name, and the buyer will then literally get the login details from the seller for the for the banking portal,
the mortgage payment.
Yeah, and then start making the payments on their behalf.
So that's where subject to comes from, is that the buyer, this investor, is coming in for $5,000 and getting the title, the deed to the house. But they're taking that deed subject to the old mortgage, where this is where subject to the name of it comes from. And it's a way for people with not a lot of money to get control of real estate. I guess the idea being the idea being on the flip side, on the buyer's side, is that they're going to get a tenant in there as quickly as possible, and they're going to try to rent the property for more than their mortgage payment, and then scoop the spread that way.
Right.
Yeah. And by the way, I've been hearing about subject to from these same group of young investor classes, where it's the teens.
Well, here's why. Is
it a TikTok phenomenon, or what's the deal?
Well, it is, and this is the new guru thing, okay? Because so here's how you know a grift is sold out. Because you see everyone making courses about how to do the grift, right? And now everyone's teaching people how to teach people how to wholesale, right? And so the wholesaling grift is done, right? So they need a new thing, and this is relevant because subject to 5 years ago wouldn't have made any sense because everyone had equity, nobody was underwater on their thing, and there weren't any desperate sellers. A scam only works where desperation meets greed. Okay, you have to be both desperate and greedy to fall for a scam. Yeah. And that's what happens with subject to, because when you have a listing agent who is not knowledgeable about the risks to the seller, right? The due on sale clause, the impacts on the seller not being able to qualify for their next transaction, et cetera.
Yeah.
Yeah,
Yeah,
and then
let's take a moment
the
though.
seller actually breaking the terms of the note, right? And you also have the seller obviously taking on a bunch of risk. But you know what you also have? The buyers, the actual buyers are taking on tremendous amount of risk that they often don't know about, because the buyer is not the frat boy. The buyer is a guy who got talked into this by the frat boy. Okay.
Right.
And then that guy uses the confidence of the listing agent, and the listing agent doesn't know anything, but he makes friends with the listing agent and explains it in a sanitized way that makes it seem like it's normal. And I know, because I've been a new agent, and it's easy to make things sound normal that you then find out later is totally wrong.
I want to pause and take a moment just so that everyone that's listening can really catch up with what's going on. We're talking about subject to more. This is a deal that came where you couldn't sell. The guy's underwater. Beautiful house, new house in Austin, Texas. Along come these offers of guys to give $5,000 for a quick claim deed or a title, take possession of the house, try to rent it, subject to the existing mortgage. Why that doesn't work is let's just walk through a couple of the risks and why we're talking about it like it's a grift, because there may be folks that are listening to this saying subject to, oh yeah, because there's a whole world out there that is promoting subject to, and we're fighting a pretty big audience. Why this is a risk and why this is because you said due on sale clause, number one biggest thing. 95, 99% of all mortgages have what's known as a due on sale clause, which means that when you transfer title to the property to another entity or another person, the mortgage needs to be paid off. Meaning that if the seller accepts selling the title, but not going and paying off that mortgage, that seller's is now in default, in material default of the mortgage. Even if they're current, they're in a material default that theoretically the bank could call the note.
Imagine this. Imagine, you have a car. Now, when you finance a car, they don't give you the title to it until you pay off the note, because, they just figured this out.
They
figured this out, I guess. We haven't figured this out in real estate, apparently. But imagine if you could sell your car without paying off your auto loan to some guy who just says, no, don't worry, I'll pay CarMax or Wells Fargo or whoever. Don't worry. Yeah, I'll make the payments. Don't worry.
I mean, just imagine that's like exactly what's going on here is, and by the way, I was just thinking about that when you brought in auto as an example. There is a thing like swap a lease or something like that where people can sell their lease, take over lease payments. I can't imagine that thing goes well. I can't imagine on a person to person. What recourse is there? You give the keys to the car to someone and you say, okay, just make sure you make the payments for me so you don't ruin my credit. What, I mean, you never see that person again. You've never met that person before.
Yeah.
And that's what this whole subject to thing is. Because at the end of the day, it's a business that this young cohort of real estate wannabes are trying to do, and I give them credit for being creative, but it really does more times than not it's just too much risk. You got the due on sale clause, you got the liability, you got the added, like you said, that loan stays active on the seller's credit, so they can't go out and get another mortgage or buy something new now because it looks like they still own the property. There's so many reasons why it doesn't. The only one it really works for is the buyer, right? Because there's very little risk there. They put a couple $1,000 up, or the manager who you said
you
as
know
an
what's
investor.
Interesting though, even for the buyers on a lot of these deals, there's way more risk than they actually think. The frat boy that talks them into it says the biggest problem people have right now with investing in real estate as a new investor, well, number one limiting factor is down payment. People have good jobs, so they want to get rental properties, but it takes time to save up 25% to put down. So they don't want to do it. That's why occupancy fraud is so hot right now, right? Because now you can buy a property with 5% down, but it'll never achieve positive cash flow, right? And so,
Right.
but the frat boy will say, hey, no, look, this guy has a loan at 3.5%. That's way lower, because the other problem with investment loans of any kind is the rate is higher, right? Even
Right.
if we're in a 7% rate environment, the investment loan is going to be 8 or 8.5, right?
Right.
And you're going to be paying points.
That's right.
Right. And so, and that's a conforming investment loan, right? If you want to do, DSCR or something, now you're into double digits very
That's
easily.
right. That's right.
The guy says, wow, all you have to do is pay the seller a few grand, pay this commission to the realtor. I mean, you're probably in this for maybe 5 to 10% total, and you're going to get a rate that's below the market value. You're never going to see a 3% rate again. This is your chance. Okay.
Listen, and this is not to be confused with legitimate assumable mortgages. That's different than the subject to what we
Right.
call the
Exactly.
grift. Right.
Exactly. Exactly. Because an assumable mortgage goes through the lender and is approved with the lender. It involves a new note being drawn. You have a brand new security instrument as a result of an assumption. It's just on the, a continuation of the original note, right? You're continuing that amortization. But
I did a podcast about, I do a lot of talk about fallacies the last year or two, because I love how, like, we as a society get into these fallacy thinking, when there was a thought before 2008 that residential real estate could never go down on a nationwide basis, believe it or not. That was actually
oh
Ben
yeah,
Bernanke said that in front of Congress in 2005, that it would never happen. So
that's when the end is near.
yeah. Exactly. Oh man. So we've covered subject to, we know that's something, and you're right. It's a lack of deals, it's a lack of capital, people coming in and trying to finagle control of real estate from other people. Now a legitimate acquisition through and listen, a subject to, maybe with certain ties to it, maybe a bigger down payment. Those might be legitimate things. But yeah, the market is ripe with this kind of thing. And it really is evidence also of where things are headed, I think, in residential. I mean, it's weird because volumes, I heard today, have hit, the demand volume has not been as low in April since 2008 or something like that.
Yeah.
The report they just posted. And yet prices on an average are still gone up in April, maybe because the few deals that have been done have been those last buyers, I think, getting squeezed just through a lack of supply. But I mean, when you look at Austin I mean, it makes sense. I mean, I looked at some zip codes in Austin, like the Rollingwood
Hmm.
and what we were talking about this yesterday, where the average home value in zip code 78746 in Austin, Texas is 1.75 million. That's more than the average home value in Palm Beach, Florida, which is like 1.5 or something like that. So like that includes Mar-a-Lago, that includes all the
Hmm.
real money,
Yeah.
and so it goes to show how askew the market really is. And now you're starting to see these folks that bought in the last few years really getting squeezed upside down. I mean, I
Hmm.
had somebody say to me, is it possible that there's people that are upside down on their mortgages today with all the equity, with all the rise in prices? Well, yes, because if you bought it, like your case in point, Tony, if you bought 2 years ago or 3 years ago in 22, 23, then and you bought that with a very high leverage, like an FHA or VA loan, chances are greater than not you are upside down right now.
Oh, certainly. Well, and just think about it. Even if you pay cash, the day after you close on a house, your net worth is lower. Okay. I mean, you start in the negative when you buy real estate because the cost to liquidate is so high that, you've lost, at least 3% of the value of that you had, even if you pay cash immediately. Right. And so if you only put 3% down, now you're basically at the waterline on move-in day.
Yeah.
What the reason why real estate has historically been such a great investment is because people keep the property for a long time. And we're keeping properties now longer and longer as I think, the average personal household net worth just continues to erode. People are unable to sell, but the average home is kept for 13 years.
Wow.
There's nobody who bought a house 13 years ago who's still living there, who's experiencing any kind of anxiety about their level of equity right now.
Right. Unless they
bought it in 2012.
Yeah.
Do you know, Bill, if you bought a house at the worst time in like 2007, like the peak of the last market in an average area in America, the average market in America, it would have taken you 7 years to get back to that original price that you bought it at. 7 years. So it would have taken you until 2014.
Wow.
But if you owned it for average of 13 years, that would mean that you sold it in 2021, which would mean that you still did incredibly well. Okay.
You still got all that money back and then some.
Exactly. The problem is when you have to sell too early. And I'm sure you've seen, regardless of any market, and I have too, anytime you have to sell a year or two after you buy, it's bad news. It's just particularly bad news now because the market's going down. And that's not something you hear all the time in real estate.
Yeah, for sure. Really great stuff, man. Any last thoughts? I mean, we both, I think, are in agreement that you've got the market heading in a downward direction. Didn't you say an interesting stat since the peak of the market, which again, we're going back to calling it 2022, 2020, 2023, Austin's down from that peak?
Since May of 2022, Austin had the greatest increase in values during the pandemic and during the fallout, right? The peak was in May of 2022. Since then, average home value, I don't know if it was average or median. I think to most people, it's kind of the same, down 24.5%.
Wow.
Since the peak 3 years ago.
I guess a lot of that was tech boom, or tech kids that came in late maybe and lost a little bit, so they had some to throw around. No, you can't make.
There was a whole lot of that. There was a whole lot of that. I mean, that was really a whole lot of it. And then, everyone has these RSU stock options, right? All the stock option income. That's how everyone was able to bid way over the asking price, right? Because they're cashing in these tech stock options and then just putting it straight onto the house. Yeah, pretty amazing.
Very interesting. Wow, what an interesting. Well, we'll have to dig deeper into Austin in the future. What's your bold prediction for the next 12 to 24 months?
I'm glad that I get 12 to 24 months, though. I've been saying rates are going to come down for the last 3 years, and I've been wrong for but I haven't given a specific timeline. I've always said, well, eventually, when they go up, the rates go up taking the elevator, and when they come down, they take the stairs. So who knows when rates are going to come down? It's a really tall building that they went up, but my prediction is really, I think the wheels have to fall off of the economy at some point during the next 12 to 24 months. Nothing makes sense. And, personal debt, delinquencies, everything is moving up rapidly. Everything bad is moving up, right? And everything good is moving down, right? Prices, values moving down, except for the stock market. So once the gambling ends in the stock market and the cryptocurrencies and the literal sports gambling books and casinos, right? Once the gambling finally stops, I think we're going to see, widespread capitulation in all the markets, including real estate's going to slide, but I think everything will really.
I agree.
And then we'll see lower rates.
Yeah, well, then they're going to have to lower the rates, but that'll be a move by the Fed. I agree 100% with everything you're saying. I think that rates will, unfortunately, in the near term, are going to go up because of the weakening dollar, everything that's going on, and it's going to be a very interesting time. Let's get our popcorn ready. You might have to become a regular visitor here, so
I'd love
I
to.
appreciate your time, and we'll see you again soon.
Excellent. Thank you, Bill. We'll see you.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.